Hey guys, welcome back to the channel. This is Cash Value Life Insurance Reviews, and today we are going through one of the most frequently asked questions, which is, can I add more premium into my IUL? And the answer is really simple. It depends. And the answer to what does it depend on is, was the policy actually structured to fit more premium in the policy from the beginning? So long story short, you can absolutely increase your premium, but the kicker is you need to decide that on the front end. And so really what this video is going to be about is not can I, but should I. So I'm going to show the same illustration here, but two different versions. One where you're essentially max funding the policy where you cannot pay any more premiums. And then we're gonna show one with a higher death benefit, and I'll explain that a little bit more. And just to give you the answer up front, it's gonna depend on what kind of risks you wanna take and also what you're trying to get out of the policy. So the most important thing that we wanna talk about as we're looking at these types of funding strategies is the relationship between the death benefit, your starting death benefit year one, and the premium that you want to put in. These are flexible policies. You could put in a very wide range of dollars into the policy and it would still be essentially the same policy. The only thing that's changing is how much cash value, how much cash growth is actually happening. And so to put it simply, we have a max funding strategy, which is also called the guideline level or guideline annual premium. You can see that on any illustrations. It'll show you really what that number is, which would essentially mean if you're paying that, you're max funding the policy. Max funding is a very relative term, but that would be the way to use it. You'd be max funding the policy. And then also the minimum premium. If you want to pay the very minimal amount, generally speaking, that is on there as well for you to be able to tell. And so that kind of gives you some parameters, and really anything in between will make the policy grow. The more dollars you put in, the more you'll be able to get out. So the interesting thing is, I think a lot of people would want to elect to put more premium into the policy just to have that flexibility going up. But the reality is there are drawbacks to that. And so that's why I wanted to show you two different illustrations. I'm gonna go ahead and share my screen and go through those one step at a time here. So the first structure that we're looking at here is showing $190,000 in death benefit, and you're paying $12,000 a year in premium. So this is kind of what I was referring to as a max funded strategy. And I wanna show you what that looks like. We're gonna go ahead and find the guideline level premium here. So this is on the illustration, it's 5 pages down. We can see the initial guideline level premium is $12,000. And what that means is that's essentially the max that we can pay into the policy. Now, there are pros and there are cons of doing this. And so I wanted to chat through that really quick. The pros are you're not paying any more fees than you need to. We would refer to this as a fully efficient policy, meaning you're max funding the policy, you're purchasing the minimum amount of death benefit, minimum amount of commissions, and minimum amount of fees, so that essentially for your $12,000 a year, this is growing as efficiently as possible. And so, $12,000 a year every single year, 20 years down the road, you're at $395 in cash value for putting $240. Now, a more efficient policy essentially means more cash growth to you and more income tax-free later in life. The downside to this type of strategy is you do not have any wiggle room going up in premium. And so the answer to this policy, if you ask me, hey, can I increase my premium here? The answer would be no. And I think that's actually a good thing because you're minimizing your fees and you're making sure that you're max funding a policy. And so if your main goal is to maximize cash growth, this is the type of design you'd want, is to maximize the policy and minimize the fees. So I wanted to show you the other illustration that I'm showing here. And this is essentially being able to put in double the premium. However, we're not putting in $24,000. We're still gonna put in $12,000. And so we get a lot of these types of illustrations where they're sold on the idea of that they have a ton of flexibility, which is essentially a good thing, is at least what they're sold on. I wanted to show you what this guideline level premium looks like. It's gonna be the same thing, but instead of $12,000 a year, it's gonna be $24,000. So you can pay $24,000 into the policy. Let's say you only pay $12,000. That's kind of what we showed here. So essentially the death benefit has doubled and the premium has stayed the same. The pros to that is you absolutely have the ability to pay more premium in up to $24,000 any year you would like. And that's really where the pros and benefits stop on this policy. So I really want to show you this because this is interesting. The death benefit obviously has to be higher if you want to put in more premium, which means it's a less efficient policy relative to the $12,000 a year that you're paying. We have some people probably saying, well, you put more dollars in, But one of the biggest risks that we incur here is follow-through risk. And so what that means is you intend to pay more than this $12,000 at some point in the future, but that's a risk you're actually taking on in the policy. We want to eliminate that. That's one of the biggest risks that we see for policyholders, is not following through on what they're planning to do in the future. But really, the thing that we want to see here is it directly affects the cash value and the total fees that you're paying on the policy. Just for having the ability to pay more premium, you are sacrificing an efficient policy. So we can see here, $12,000 a year, let's say we pay that for 20 years. We're at $362 in cash value. And we're going back to the more efficient design to where $12,000 is the max, and we're $395. So we're $30,000 less in cash value. And also we're paying a lot more fees. We can also see the fee structure here. This is the higher death benefit. We can see what they're deducting, what the carrier's deducting. 20 years down the road, the total amount of fees that you're paying is $54,000 versus the well-structured policy is $38,000. So that's $16,000 more in fees that you're paying into the policy just for the ability to increase your premium. And like I said, the follow-through risk is one of the biggest risks that you can incur. And so it really depends on what you're trying to do. If you are trying to maximize the dollars you have set aside for tax-free growth, then it might be worth, max funding the policy from the get-go. And that might mean getting a smaller policy. And so if you are really wanting the wiggle room up front, it's gonna cost you more death benefit, which means more fees and less cash value. And so hopefully that answers the question. We get a ton of those questions, and it makes a lot of sense because people want to know really what's the parameters around these policies paying premiums. And so if this is you, if you have questions on this, if you have a policy that looks like the higher death benefit, but you didn't know you're paying more fees for that, feel free to send it over. You can go to our link below. It's gonna take you to our website to allow you to upload your policy for us to review for free. We can also chat about what you're really hoping to do with these types of products. And so hopefully this is helpful for you guys. We're gonna have more frequently asked questions answered on this channel soon, so be on the lookout for that. But until then, you guys have a good one.